Hello and welcome to chapter 11. We will be talking about depreciation here. So our primary learning objectives here is to look at the concept of depreciation. We will be accounting for changes in depreciation rates. We will calculate depreciation for partial period, calculate depreciation using currently acceptable methods, and the ethical implication related to depreciation. So what really is depreciation? So this basically is the amortization in the general process of cost allocation and specific name for the process for intangible assets. Depletion is used for natural resources. So what they're saying here is we have three different types of assets if you, the two different types of assets if you think of your balance sheet. So there is property, plant, equipment assets, and there are intangibles. So we said the primary difference between both of those two was the presence of physical substance or lack of. Okay, so depreciation is a concept where the cost of your capital asset, your long-lived asset, is spread over its useful life. If we are looking at physical assets, such as your property, plant, equipment items, then we will call it depreciation. If we are looking at intangible assets, then we will call it amortization. In an event the business does have natural resources as an asset, then we call it depletion. Okay, so at this point in time, we just expect you to recognize that there is something called as depletion with regards to your natural resources, but the focus will be on depreciation and amortization. So your depreciation has to be for the assets that do have the definite life. Okay, depreciation for property, plant, equipment, except for the land. Land is the only item under PP&E that is not depreciated, but all the other capital assets that you have under that section will be depreciated. Now, for the asset, if there are significant parts of the PP&E asset that should be identified and depreciated separately as components, then we need to do that. Okay, think of a building. When we look at the building is one asset. But if you think of it more closely, then building is made up of roof, it has doors and windows, and it has the structure. Now, all of these three components have different estimated life attached to that. So it won't be fair for us to just take that as a building and depreciate that over 25 years or 40 years. Okay, it doesn't make sense. So that is where we will have to start componentizing these elements and start depreciating them separately. So your multiple components may be grouped together for calculating depreciation, but that is only when they have the same useful life and depreciation methods being used. All right, so when you're looking at different classes of roofs, if they have the same method applied, same estimated life, then we will go ahead and put them together as a single item or the single component or a class. So parts of each PP&E asset that are not individually significant can be grouped and depreciated as a single component. An application of components for the purposes of depreciation is required by both ASPE and IFRS. However, IFRS is more detailed and stricter. So what they're saying is under IFRS, there are stricter guidelines when it comes to componentization. So for depreciating our capital assets, we do have different types of methods that are available. So under the accounting methods and the tax-based methods. So what we use onto our books from the accounting perspective is different than what CRA uses for tax purposes when they calculate depreciation. So we on the accounting side use straight line, declining balance, and the activity-based method. And from the CRA's perspective, they would only use CCA method, cost as the capital cost allowance. Now, what do we need in order to depreciate our asset? So for the depreciation, there are a few things for us to keep in mind. One is we are going to need the cost of our depreciable asset. Okay, and cost is what was discussed in the earlier topics as to how do you determine the cost of your capital asset. Once we have the cost, then we will start depreciating the asset. Now, when do we start depreciating the asset? Is when your asset becomes ready for use. It's available for use, right? Now, if you're buying an asset, then that's usually easier to determine. But if the company is constructing their own asset internally, then on the date that the asset is available for use, that is the day where your cost capitalization stops and the depreciation starts. All right. So on the day it's available for use, we will start depreciating that asset. Now that depreciation ends when that asset is derecognized, meaning either the asset is sold or it's burned in a fire. For one reason or the other, we do not have the asset. That's when we stop the depreciation. But we also know that we have talked about our discontinued operations. So under that, we also said that if there is a decision to discontinue operation, and we had talked about those 6 criteria in the earlier topic. In case you want to refresh that, go back and look at it. So once your asset is reclassified as held for sale, it moves from capital asset, from a long-term asset onto a current asset category. Current assets are not depreciated. So your process of depreciation only will be between the day when your asset is available for use, and the end is either when it's derecognized, you take it off your books for any reason, or if it's reclassified to held for sale. Okay, now we will continue depreciation, and this is an important point here. So we need to continue depreciation even if the asset is idle or has been taken out of service, unless it is fully depreciated. If your asset is with you physically, then we have to keep the depreciation process going, even if the asset is idle or it is taken out of service up until it is fully depreciated. Now, the asset's useful life and physical life are two different things. What we look at is the useful life, and useful life in our accounting term is the period of time over which the asset will give us economic benefit, meaning that it will help us generate revenue. The physical life of the asset can be much longer. Okay, let's say the useful life, when we say the asset's useful life is only 5 years, meaning that this asset will only help us generate revenue for 5 years. After that 5 years, the asset might still be functional. It would still be good. If, let's say the physical life of your asset is 7 years, then your asset is still good past that 5 years time, but the revenue generation capability is only restricted to that 5 years. So that is the difference between your useful life and physical life. So you might end up seeing both of those in the accounting context. Now, the life of your asset can be expressed in terms of the time, which is the number of years or the number of months, or alternatively, it can also be expressed in the number of units. And we'll talk a little bit more about that in the following slides. So the factors that will affect the useful life of the business is the economic factor, such as the obsolescence of your asset, the physical factor, which is the wear and tear, and the legal life, which basically is the expiration of your contract. The legal life comes into play more so when we are looking at the intangible asset, but not to say that they don't exist in PP&E world. They do exist. It really depends on the type of the asset, but it can be more pronounced in the intangible world. So your depreciable amount is made up of two concepts. One is the cost of your asset. The cost of your asset is any money that the business has incurred up until the time your asset is ready for use, which was needed in order to bring your asset to a particular location or to a particular workable condition. Okay, so up until that time, any cost that the business has incurred can be capitalized. And once again, the cost of what makes up that capital cost was discussed in the earlier topics if you want to review that. So once we know what the cost of our asset is, then we look at the residual value. The residual value is the estimated cost for which we will be able to sell your asset at the end. So your residual value is the net amount that is expected to be received for the asset today if it were the same age and in the condition expected at the end of its useful life. So what is our expected recovery at the end of the useful life? So that's your estimated residual value. Now that residual value, so cost minus your residual value is your depreciable cost. So we need to book depreciation that is equivalent to this depreciable cost. Now the depreciation continues as long as the residual value is lower than asset's carrying value. Carrying value of your asset is the historical cost minus accumulated depreciation gives you your carrying value, and it's sometimes also called as net book value. So as long as your residual value is lower than the carrying value of your asset, we will continue the process of depreciation. Now, one thing to keep in mind with the residual value is the residual value has to be evaluated annually under IFRS rules. Not the same requirement under ASPE, but IFRS does require us to look at that. Under ASPE, the depreciation charge is the higher of cost minus the salvage value over the life, or cost minus the residual value over the useful life. Now, the concept of salvage value only exists under ASPE. What this is this is asset's estimated net realizable value at the end of its useful life. Now, the partial period depreciations are also allowed. So what if your asset was only purchased, let's say if you have the year of January to December, your asset is purchased on March the 1st. Okay, so that is your partial period depreciation. How should the company account for that? So when the asset is acquired sometime during the year, a partial period depreciation is charged. Now, there can be various approaches towards this. One is the company can decide not to take any charge for the first year and take full year charge in the last year. Or the company can go ahead and prorate that depreciation as well. So they can say, if I had the asset from March to December, that is 10 months of depreciation and I will take 10 months. That is acceptable as well. So the procedure is to determine the depreciation for the full year, and then we will allocate the amount to the partial year. Okay, so in this case, if we had the asset for 10 months, then we will calculate the per annum depreciation, but prorate that for 10 months out of 12. This is a quick rundown summary on all of the three methods that are available. So we have our straight line method, your declining balance and activity method. The first three methods are what are used from the accounting perspective, and CCA method, which is the capital cost allowance method, is used by Canada Revenue Agency. So under the straight line method, we take our depreciable cost, which is your cost minus your residual value, divide that by your depreciable life, and your depreciable life is expressed in number of years here. Your annual depreciation remains constant, and if there is partial depreciation needed, then we will go ahead and adjust that. This method is the easiest of all. Declining balance method, we look at our beginning net book value, multiply that with the depreciation rate. Now, depreciation rate is sometimes stated, other times we will have to calculate that. So we take 1 divided by the number of years of useful life to calculate our depreciation rate. It could be a declining balance method, could have the single rate applied or the double rate applied. If it's the double rate, go 1 divided by the useful life in years, multiply that rate by 2, or whatever the factor is. Okay, so beginning net book value times the depreciation rate will give you your depreciation calculation. The annual depreciation will decline because the net book value is going to decline over time. If we need to prorate that for partial years, then we will do that. Under the activity-based method, we calculate the per unit cost. So we take the depreciation rate times the activity level. So here, the life of your asset is expressed in the activities. Okay, so either it can be the output activity or it can be the input activity. So 1 divided by the total activity that is expected over the life of the asset gives you the per unit cost, And that per unit cost is then multiplied with the output activity level in each year to calculate our depreciation. So the annual depreciation from one year to the other will vary depending on the activity level, but this is the only method under which we do not need to do the partial year depreciation because your activity level would already adjust for that. Your CCA capital cost allowance is something used by the Canada Revenue Agency. So they look at the beginning UCC, which is the undepreciated capital cost. So they look at the undepreciated capital cost and multiply that with the CCA rate, which is your capital cost allowance rate. The CCA rate, technically speaking, depends on the type of asset that we have. So CRA has a huge list of all the different types of assets that they have and a predetermined CCA rate that goes with each one of these assets. So they would multiply the UCC with the CCA rate. It will decline because the UCC rate is the similar concept to net book value. It's similar, not the same. So because the UCC keeps going down, your depreciation, annual depreciation will also decrease over the life. Now, CCA does apply the half-year rule. Remember, with our earlier asset, we said our year was January to December, but our asset was purchased on March the 1st. The Canada Revenue Agency would say, you know what, that's too much information and I don't have time to account for all of that. Too complicated. I have got too many businesses, too many assets to account for. So the easiest thing I'm going to do is I'm going to apply a half-year rule for everybody. Okay, so in that case, even though you had the asset from March to December in that year for 10 months, the CC under the CCA in the year of addition, there will be half-year depreciation. Same rule would apply even if you got the asset on December the 1st. You had the asset only for 1 year, but you would still get half-year depreciation under the CCA rules. So straight line method, as we said, straight line method is the easiest of all of the methods that are available, and that's why it's a fairly popular method. Once we have determined our depreciation rate, then it practically remains the same unless we are prorating in the year of acquisition. Because it is so easy and straightforward to use, it is quite widely used in the industry. The flip side of this method is that it assumes that the asset would actually deliver the same economic benefit each year, and this may violate your matching principle. When the companies decide on the depreciation methods, they actually have to tie it with the actual use of the asset. And when we say use of the asset, that indirectly ties to your revenue as to how that asset is helping you generate revenue. So in this case, under the straight line method, the method is assuming that it's used the same way each year, and the benefit out of that asset is the same every year after year. So this assumes that the maintenance expense is about the same as well, which usually is not the case. Your assets don't need so much maintenance in the earlier years, but as they grow old, then they do require more maintenance cost. That also violates your matching principle. This will result in increasing rate of return because the book values will decrease. On the other end, we got our declining balance method. This is also called as the diminishing balance method, different terminology, same idea. This method will create your higher depreciation expense in the earlier period and lower charges in the later period. Usually the declining balance method is used for the assets which are technology. Okay, so different types of assets could have different types of the depreciation methods attached to that. So it depends on the asset because the technology changes so quickly. Generally, we see the declining balance method applied to technological assets where the depreciation is higher in the earlier years and then it slows to get lower. But the revenue generating out of these assets is also higher in the initial years, and as the technology becomes obsolete, the revenue generating capacity goes lower. So the basic assumptions here is that many assets offer their greatest benefit in the earlier years, and repairs and maintenance costs are often higher in later period. So the version that we use in Canada for the declining balance method is the rate or the percent that is calculated as a multiple of a straight line rate. So what that means is, one, divide that by the useful life of the asset, that's your rate. If the business is using an accelerated rate, they can double the rate. Applies the appropriate rate to the asset's carrying amount at the beginning of each period, and depreciation stops when the carrying amount reaches its residual value. We can never over depreciate our asset. So we start with the depreciable cost or the cost of your asset, depending on the method, but we have to be left with the residual value. If there is no residual value, then the depreciation or the total net book value or the carrying value of the asset should be zero at the end, but you can never over depreciate asset in any context. No matter what method you're following, you can never over depreciate your asset. The activity method is quite similar to the straight line method. So with the straight line, we were calculating the depreciation based on the number of years. So here, our activity is based on the output measure, or the useful life of your asset is based on the output, which is the units produced by the asset, or the input, which is the number of operating hours. So instead of depicting the life in number of years, the life is depicted in the output or the input units. So we take 1, divide that by the output or the input level that is defined over the life of the asset. That gives us the per unit cost, and that per unit cost is multiplied in each year with the activity level. Even in this context, make sure not to over depreciate or under depreciate your asset. Okay, so because your activity level is already adjusted, you don't have to prorate in any year. Your limitations of this method is that it's not appropriate when asset's life is affected by economic or functional factors that are unrelated to usage. It approximates for only a few situations. Most extractive industries refer to as depletion, and this is difficult to estimate units of life of an asset. Now, this is something that we expect you to know, but this is not examined depletion of the mineral resources, because this is very specific to, to natural resources. So cost of acquisition, exploration, and development should include your asset retirement cost that needs to be capitalized. And this is your natural resources that are extracted. Depletion is the cost using the activity level. So based on the number of units of production, so how many units have you extracted, based on that, the depletion cost is booked. Depletion charges is initially debited to inventory as the product cost, and when the resource is sold, at that time, inventory is credited and cost of goods sold is debited. So where an equipment's useful life is clearly linked to the life of the resource, it is also amortized using units of production method. Then comes your revision of depreciation rates. Now your revision of depreciation rates, what we are using to calculate your depreciation is the cost of your asset, the residual value in IFRS context, and then we have your estimated life, whether that is represented in the number of years or the number of units output or input. Now, out of those, cost is the only solid number. Your estimated useful life as well as your residual value, these are both estimates that are used. Now, IFRS requires these estimates to be reassessed and revalued at the end of every year to see if they are still the same or if they have changed. Okay, now because they are estimates, they tend to change, and if there is any change, how should we account for our depreciation is what we are discussing here. Now, one most important thing that you got to remember is, at the time that your depreciation for the prior years was booked on the books, at that time the information was good and solid, which means if my depreciation information is changing in the current year, then we would only account for that information in the current year and going forward. We will revise our depreciation rates and depreciation expense calculations based on the new information and the carrying value of the asset for the periods going forward. We will never come back and make a retrospective adjustment to the prior year for a single year or a cumulative catch-up adjustment. We just never would. That information was good at the time we booked, so we just leave it be. If we have new information in the new year, we will account for the new information, revise our depreciation, and take that from going forward in this year and following years. So this will never affect your prior year depreciation. The same idea applies if the company decides to change their depreciation method. So let's say the company was using the straight line method in the prior years because it was easy to use, but going forward, they want to use units of production. So if there is a change in the depreciation method, then the change in depreciation method is treated the same as the change in estimates. So we will account for that method going forward as well. We will not make any retrospective application. Leave that information be. So your new depreciation is calculated based on undepreciated cost remaining along with the most recent estimates of residual value and remaining useful life, and we will only account for that information going forward. And finally, how do we choose the depreciation method? The company, there is a lot of professional judgment that goes into picking a depreciation method, but the basic idea is that the company needs to make sure that the depreciation method reflects their economic reality. How are these assets being used for revenue generation? That based on the use of the asset, they should pick a method that will most closely reflect the cost. So we are trying to match this. So the matching principle, which is matching your expenses to your revenues, we want to match this as closely as we can. So we have to tie our choice of depreciation method with the actual usage of the method, which actually ties into how it's helping you generate revenue. Now, the choice of the depreciation method is going to affect your financial statements, your statement of financial position, your income statement, as well as your ratios. Regardless, one most important thing, guys, regardless of what method the company chooses, whether that is straight line, units of production, or diminishing balance or declining balance, if you look at your asset over the life, your total impact is going to be the same, because we can only depreciate the depreciable cost. Cost minus the residual value is the maximum amount of accumulated depreciation we can take. So we can never have different end result under any of those methods if we are looking at it cumulatively. However, when you look at these methods from one year to the other, they would tend to create different impact on your financial statement because your depreciation expenses are different. So from one year to the other, your individual impact on that year will be different. But when you look at it cumulatively over the life of the asset, it is going to give you the same impact. So that is all we had for this particular chapter. Thank you so much for listening in.